Hello, and welcome to episode 6 of our financial planning education series. During this episode, we'll review how to incorporate tax profiles into planning for our clients, and we'll dive into some more complex fact patterns to illustrate situations we've encountered over the years. Today, I'm joined by one of our senior financial advisors, Bob Waskiewicz, who leads our internal tax alpha group. In addition to being a certified financial planner, Bob is also a certified public accountant, so he brings to our team a unique perspective and a wealth of knowledge regarding tax planning. Thanks for being here today, Bob.
Hey, Susan, thanks for having me.
Of course. So, to get started, Bob, why don't you tell us how you begin your tax planning analysis for our clients?
Sure, Susan. So, first, we review the specific facts of each client situation and we create a tax profile for them. So, even though everyone has their own unique situation, there are certain key factors that cause us to emphasize specific tax planning techniques. For instance, is a person retired or close to retirement? Is there a reason their earnings might decrease considerably in the near future? If the answer is yes to any of these questions, we'll begin to think about ways we can plan around the required minimum distributions. Is the person a business owner? That will alert us to review any existing retirement plans and analyze whether any different types of plans would be more beneficial than what they currently have. Is the client charitably inclined? If so, this will trigger us to review the most tax advantaged ways to benefit both the client and the charity. Will the client be incurring any large amount of capital gains? If so, what techniques can we use to reduce or offset these gains?
Thanks, Bob. So, why don't we explore this in more detail by using some case studies? So, here in our first case study, we find a married couple. The husband, Ernie, turned 72 this year and is still working, but his salary is likely to decrease significantly in the future. Ernie's wife, Liz, will turn 72 next year, and her required minimum distribution, or RMD, from her IRA will be significantly lower than Ernie's RMD. Also, Ernie and Liz work closely with several charities and would like to make a contribution of $30,000 over the next 2 years. So, Bob, can you show us what opportunities you see here?
Sure, Susan. So the four major opportunities we spot here are one, the ability to time Ernie's first RMD, two, exclude RMD income, three, bunch charitable deductions, and four, take advantage of a higher tax rate by front loading charitable gifts. Like we said, Ernie's income for this year is likely higher than it will be in future years. Because there is potential for future lower income tax rates, it is important that we plan for him to have the flexibility to take advantage of this opportunity without unnecessarily increasing this year's liability. As we mentioned, Ernie and Liz intend to make charitable contributions of $30,000 over the current and next calendar year. By electing to donate Ernie's RMD, they can exclude that amount from income. This approach would prevent them from increasing their current year tax liability, provide them with future tax planning flexibility, and accomplish their charitable goals. In this case, this approach is more efficient than donating appreciated securities because of the increased standard deduction as a result of tax reform. If they were to donate appreciated securities, much of their tax benefit would be wasted as they were already given a majority of this benefit via the standard deduction.
Thanks, Bob. I like this technique because it's a win-win situation for both the charity and the couple. So why don't we take a look at our second case study? Christopher has $5 million worth of gold bars that have an embedded $1 million unrealized loss. Christopher wants to get rid of the physical gold, but does not want to be completely out of this area of the market. Christopher also has a $1 million capital gain associated with his business activity. So, what did we do in this situation to assist Christopher?
In this case, we advised Christopher to sell the gold and realize the $1 million capital loss. In doing so, he was able to offset $1 million capital gain from his business activity. We then purchased a gold ETF while gold was still depressed and rode the market up as the value of gold increased. Because we were able to offset his gain, Christopher's taxable income, which consisted mostly of capital gains and Social Security, was lower than in previous years. As a result, he was able to take advantage of his lower tax rate to convert his existing IRA to a Roth IRA. This money will now grow tax-free for the remainder of Christopher's life. Had he left the money in a traditional IRA, he would be subject to required minimum distributions at age 72 and would be taxed on that distribution as ordinary income. He is not required to take a minimum distribution from the Roth IRA, but in the event he needs cash, he can access these funds tax-free.
That's very interesting. Broth conversions are definitely an important planning technique that can apply to many individuals. So finally, let's turn to our third case study. Here we find Joan. She's a single client with very little family and $15 million of assets. She was making over $1 million each year, but as she moves closer to retirement, she scaled back and even more recently transitioned to being an independent contractor. Joan is not pulling anything from her portfolio, but she is paying a lot in tax on her capital gains distributions for money that she'll likely never use. Also, Joan has major charitable goals. She actually plans to leave about 50% of her estate to various charities. So, Bob, why don't you tell us about some of the solutions we came up with for Joan?
In Joan's case, we were able to create a donor advised fund while she was still earning a higher salary and move appreciated securities worth about $500,000 each year for several years prior to her becoming an independent contractor. Joan received the benefit of those deductions in the years she moved these amounts to the donor advised fund while she is still earning a larger salary and therefore in a higher tax bracket, but can now gift the money to the charities periodically over a longer period of time as she sees fit. Now, as we mentioned, Joan transitioned to an independent contractor, so she now makes about $150,000 a year and also needs to set up a retirement plan. We analyzed the benefit of establishing a SEP IRA versus a solo 401k. For the SEP IRA, she would be able to contribute close to $25,000, which would result in about a $6,000 tax savings. With the solo 401k, she was able to contribute approximately $50,000, which generated a tax savings of approximately $12,000. The primary difference in this case is the ability to make an employee contribution. For the solo 401k, you're permitted to make an employee contribution of up to $26,000 for individuals who are over the age of 50. And you are also able to make an employer contribution based on the income of the business. Conversely, the SEP IRA only allows for an employer contribution based on the business income. It does not permit the employee contribution as the solo 401k does.
Thanks, Bob. I love that we were able to double what she could save to her retirement plan just by choosing the right vehicle. So, as you can see, there are many multifaceted tax planning techniques that can be utilized depending upon your unique situation. We at Wescott review your tax situation in great detail to ensure that you are achieving your goals in the most tax efficient manner. So, Bob, thanks so much for joining me today and for sharing your insight and expertise around complex tax planning. And to our listeners, I'll look forward to speaking with you again in our next episode.